Hi, this is Ken Lake with MAC's Technical Market Review for Tuesday, March 7th. Well, we've seen a little bit of a turnaround lower in the markets in the last 4 days. The market was very overbought 4 days ago. That correction began at that time, and we're a little lower. The next big benchmark will be Thursday's USDA report, the supply and demand report. The big number to watch there is Brazilian corn and soybean production. Many analysts are continuing to raise the production numbers there, both in corn and beans in Brazil. So we'll see how the USDA, or how close the analysts come to the USDA numbers. But I would look for this market to be sideways, probably a little bit lower going into Thursday's report. The chart we have in front of us right now is May corn, and you can see 1, 2, 3 out of the last 4 days lower. Momentum indicators just mid-range here. We're tracking the 20-day moving average, however, so support's right here in this 378, 376 range, right where we closed today. So we haven't really broken support. Long-term support down here with a 200-day moving average at 371. Not real concerned about those lower support levels being broken at this time, but we have to be really sensitive to the fact that there's lots of corn out there, and farmers with 2016 corn production should be pricing into these rallies and using that 375, 380 May corn value as a place to sell this old crop corn. Likewise, D's corn holding 20-day moving average support 396. We've been avid promoters of selling $3.90 to $4 D's corn futures. Haven't changed our mind about that. Momentum indicators turning lower, and again, I think we'll still be kind of weak going into Thursday's report. May soybeans, same sort of chart pattern. We've been down 3 out of the last 4 days, but notice that we broke hard from this 1085 point, and with $11 as the value that I'm measuring from, which was last summer's high to last fall's low. I mean, notice that we've retraced nearly 80% of that move. We do not believe that there's any reason to hold old crop beans beyond here. Now, the market is a little weak and oversold, and you can make the argument that you should hold till this indicator started to turn a little more bullish. But once again, with the USDA supply and demand report looming on Thursday, there may be a reason to go ahead and continue to sell old crop beans. New crop bean values look pretty much the same. You know, the big conundrum we have here is you know, prices are easily $1.50 higher than they were 1 year ago. Here is March of 2016 that we're down to $8.75, and we've traded as high as $10.34, $1.50 higher, basically in March of 2017. So we have analysts out there telling us we're going to plant an additional 6.5 million acres more beans this year. The South American crop has no problems whatsoever. I should temper that a little bit and say there are some problems down there. It's not a huge crop, but it's certainly bigger than last year's problem-strewn crop that they had last year. No reason to not be selling into the November 2017 crop soybeans. Most of our customers have sold quite a bit of that. And if you're not comfortable with the sales you have on at this point, that is to say, if you don't think you have enough sales on, you should probably continue to wade into those to that contract and get additional soybeans sold. Wheat's just sort of burning higher here. This is a May wheat chart, and notice momentum indicators only mid-range. I've told customers that have 2016 crop wheat, 2015 crop wheat, that we will watch for a weather pattern to develop in the Southwest. Typically we see a cold snap in March that we can trade that threatens the emerging crop or the crop that's coming out of dormancy, something that we could sell. And we would target this 470 range as being a place to make that target, but have to be sensitive to the overhead resistance here. There's a 200-day moving average at 460. You know, plenty of wheat out there, unless you're going to sell the carry in the market and maintain quality. No reason to own wheat. Likewise, actually, conversely, in the July wheat, you know, world wheat supplies are huge. U.S. wheat supplies are big. No real reason to go higher here except that U.S. acres are the lowest in 50 some years. This should be treated somewhat as if it's a short crop year, in as much as the U.S. crop will be fairly small, tempered by the fact that we have plenty of on-hand stocks. So price will continue to burn higher. Basis levels don't need to do too much here, simply because we have plenty of 2015 crop, 2016 crop, with the 2017 crop coming on. So no real reason for basis to improve or spreads to narrow either. So my recommendation for customers with new crop wheat is to probably set on this stuff right to harvest time. Make your decisions at harvest time. Do not expect to see decent or at least attractive DP rates, because again, market carries are pretty big and basis values are pretty wide. So DP rates will not be conducive to storage here, and we'll probably be recommending that we sell wheat right off the combine, with little recommendations to take coverage after that sale.